Now, I want you to understand, and I must apologize, I love bankruptcies. I love defaults. Because as a scientist, and all academics need data to test their models, build their models, and to make forecasts. And so when there's lots of bankruptcies, this is a good thing. Not because I'm sadistic, but because I need data. So I was very happy to hear, I'm sorry if this is going to offend somebody, but I was very happy to hear about your big shipping company, King, going bankrupt a few weeks ago. And I have some data on whether or not that bankruptcy could have been predicted, maybe 2, 3, or 4 years before it took place. And I'm going to discuss both a model I built 50 years ago in the US and also a model we built here in South Korea with Professor Young-Ho Yum from Yonsei University in 1995. And I met Professor Yum earlier today to discuss how well our model is doing after we built it 20 years ago, and whether or not it is still an accurate model even today. And so that's the plan. Macroeconomic, markets, etc., and then microeconomic analysis of companies later on. I hope that you will understand where we're coming from and talk about the current conditions and outlook. Let's talk about where we are today. About 1.5 years ago, I began to do research and writing and consulting about where we were in the credit cycle. And it was very clear we were in a benign credit cycle. And what I mean by benign is dealing with 4 metrics: default rates of companies, recovery rates if there are defaults, interest rates and credit spreads in terms of what the markets are asking for with respect to interest rates on risky debt, and liquidity. 4 metrics if we have low default rates, high recovery rates if there are defaults, low interest rates and low spreads, and high liquidity, then we are clearly in a benign cycle, and the outlook is good. If, however, we begin to observe higher defaults, lower recoveries, higher interest rates and spreads, and lower liquidity, then we begin to fear of another crisis in financial markets. And so 1.5 years ago, when I began to think about this issue, I thought of the cycle in terms of baseball. As you know, in baseball, there are 9 innings, and then the game is over. About 1.5 years ago, we were clearly in the benign cycle, and I felt we were in the 7th inning of the game. 2 more innings, and the benign cycle would be over, and we perhaps would start another stressed cycle. Last February of this very year, about 8 months ago, I felt we were in the 9th inning, and the game was almost over, and we were ready for a stress cycle. But the score was tied. And as you know, in baseball, if the score is tied at the end of 9 innings, you have extra innings. Also in Korea, And the game can continue for many innings until one team scores more a run or several runs to end the game. So we were, I felt, and we are today, in extra innings of the benign credit cycle. The question is, how long will the game continue before it ends? In February of this year, I felt we were in the ninth inning, and the score was tied. And who would determine how long the game would continue was the Federal Reserve, Bank of China, European Central Bank, and now Bank of Japan, and probably the Central Bank of Korea. Because this year, at the January, February, all of the major central banks of the world began to pump enormous amounts of liquidity into the financial system, stimulating more debt and hopefully more growth, fearing that the financial markets were on the verge of another crisis. And that's where we are today, in my opinion. Growth is not very strong, but we are not in a crisis. As a matter of fact, the stock market and the bond markets have reacted very well since January and February of this year. For those of you who follow the finance industry, you probably know that. So let's talk about the four metrics, where we are today and where we may be going. Just to be clear, when I'm going to be referring to default rates and recovery rates, I'm going to be referring to risky debt market known as high-yield bonds or junk bonds. Those are bonds rated below investment grade, high yield or junk. And as you know, I believe there are several rating agencies here in Korea, Standard & Poor's, Moody's, Fitch, or the local affiliates of those agencies. And they rate the creditworthiness of bonds and loans. If the bonds are below investment grade, BB plus or lower, or Ba1 or lower, they are so-called high yield. Now, in the United States, we have a very large high yield market. Today, about $1.7 trillion. That's a lot of one. I guess you add 3 zeros and you get from 1.7 trillion, you get the amount of one. And that is a very large market. So, for example, the corporate investment grade market is about 4.3 trillion, and the high yield about 1.7 trillion. Together, about $6 trillion US of corporate bonds. So high yield is a significant portion. And we have two types of high yield bonds. Something called a fallen angel. That's a beautiful bond at birth, investment grade. But like many people, sometimes companies, as they get older, they get uglier. They lose their hair, they develop wrinkles, and they don't look so good. And they get downgraded from investment grade to high yield or junk. I think that's the case in Korea. But we also have in the US, more than anywhere else in the world, original issue junk. That's a bond that's issued at a low rating with supposedly a high probability of default. But we have risk and return trade-offs, and investors may buy these bonds because of the high promised yield. And money has been pouring in to the high yield market because interest rates are so low globally. What's the government rate here in Korea? Say 5 or 10-year government bonds. What's the interest rate? Somebody tell me? 1%? 2%? 1.2. Okay. In the US, about the same. 10-year, about 1.5, 1.6. Very low historically. But high yield, 6, 7, 8%. So the question is, if we buy these bonds, what is going to be the likely default rate? And if there is a default, the recovery on the default. How much do you lose? And then you have to compare that with what you would earn if there's no default. So it's a very clear risk and return trade-off market. And this market is the market that we find has the most defaults. So let's take a look at this market. This shows the growth of the high-yield market from 1978, when it was very, very small, maybe 10 billion US dollars, to today about 1.7 trillion dollars. And we have the concept of defaults. So in this column, table, in the last column it says default rates. Very simple idea. How much is outstanding and what percentage has defaulted? There are 3 types of defaults. If the firm goes bankrupt, all securities, all debt is in default. Like your bankruptcy law. We call that Chapter 11 in the US. Second, if the firm misses an interest payment and does not cure it within 30 days, the grace period, that is also a default. But it may not go bankrupt, but does not pay its interest on a timely basis. And third, we have another definition of default called distressed exchange. That's where a company makes a tender offer to the debt holder saying, instead of the interest we're supposed to pay you, we're going to offer you maybe cash, but less than par value. Or we're going to offer you equity instead of the debt. Or we're going to offer you new debt with maybe a longer maturity or a lower interest rate. Any one of those is considered a distressed exchange and also a default. I read in the Wall Street Journal today that in China, they are now going to start using this concept of distressed exchange, where companies who are having trouble meeting their interest payment are offering something in exchange for the debt. Is it possible here in Korea for this to take place? For companies to offer like an exchange of what they... Yeah, I think so. It's pretty common throughout the world. Any one of those 3 is a default. So let's take a look at default rates. This data shows the trend in default rates since 1989. Notice we've had 3 periods in the US, 1990-91, 2001-2002, and the great financial crisis of 08-09, when the default rate was above 10% in 1 year. We define then a crisis period when the default rate goes above 10%. That's about 2 standard deviations above the historic average. Historic average, 3.4%. So think about default rates as one measure of the credit cycle. And we can see there were 3 periods when we had very high. Notice in between, we have periods when the default rate was very low. That has been our definition of a benign cycle, low default rates. And historically, even if you go back to 1970, the default rates, by the way, the yellow bars represent recession periods. The line graph represents default rates. And notice that the default rates during the periods when they're below historic averages are in the benign cycle. And they have lasted between 4 and 7 years. That has been the typical length of a benign cycle, 4 to 7 years. Where are we today? The right-hand side, you can see on the right-hand side here, there's not much light here. So the period 2010, 11, 12, 13, 14, 15, we are now 6 years and about 8 months, 6 2/3 years in the benign cycle. The longest it's ever been since 1970 has been 7 years. So when I began thinking about the benign cycle, I was wondering how long it would last. But just the last few months, notice the point on the right-hand side of the graph, for the first time since 2009 in the United States, the default rate has risen above the historic average, above 3.4% for the last 12 months. It's about 4.5%. So the first metric that we look at in terms of the benign cycle, default rates, check mark, no longer in the benign cycle area. Second metric, recovery rates. In the United States, we have a very big market called distressed investing. These are mainly hedge funds investing in securities of distressed companies. It's a pretty big market, about $400 billion US under management, more than 200 financial institutions, and they, like me, love defaults, because this is the raw material for their investment strategy. The whole idea, of course, is to invest in a company's bonds or loans with the anticipation the company will be restructured positively and the value of the bonds and loans will increase in value. The typical bond, just after default, sells at about 40 to 45 cents on the dollar. So par value is 100, distressed is 80, 60, and then around 40 to 45 cents on the dollar is the average value historically for a defaulted bond. And that continues to trade while in bankruptcy reorganization. So I don't know how much debt is outstanding for, is it Hanjin shipping? But take a look at the bonds, and by the way, they filed for bankruptcy in the United States, as well as perhaps here in Korea. And it's a very delicate situation because many of their ships are loaded with cargo, but they are not being delivered to the ports because they can't pay people to take the goods off the boats, like in Los Angeles. There are many of their boats there. In bankruptcy, the debtor, the company, is protected against creditors until they decide to either restructure or to liquidate. We call liquidation Chapter 7. Reorganization or restructuring Chapter 11. So it could take 1, 2, 3 years to restructure. In that period, the debt holders receive nothing. The people who own the bonds or the loans. Usually, they end up getting new equity or new bonds from the company, if the company continues as a going concern. So this dynamic is a very interesting dynamic of valuation of corporate bonds and loans. But it's valuation in bankruptcy. In fact, I teach a course at the Stern School about how you value companies that are in financial distress, using the same methodology that you would use to value companies that are normal in normal going concern. Recovery rates we define as the price of the bonds just after default. What you could sell the bonds for if you own them, or what it would cost you to buy the bonds if you were a distressed investor. Typically, when there is a default, the bonds drop in price, as I said, on average, between 40 and 45 cents on the dollar. So if you look at 2014, when the default rate was relatively low, 2.1%, the recovery rate, the average price, was 63 cents on the dollar. Very high. And that's what we usually find. Low default rates, high recovery. This is very important, by the way, for banks as well as investors. If any of you work for banks, you have something called Basel II or Basel III, which determines how much capital you need to hold against expected defaults and losses. Banks throughout the world need to have models to assess the probability of default. And we're going to discuss those models after the break this afternoon. And one of those models we're going to discuss is a model we built almost 50 years ago called the Z-score model. I don't know how many of you have heard of How many of you have heard of Z-score? Raise your hand. Ah, good. So there have been some. And the rest of you, of course, at the end of the day today, will hear about Z-score, whether you like it or not. But you'll hear about it. And I'm going to use the Z-score several times this lecture and the next one. 2015, the default rate rose to 2.8%, and the recovery rate dropped to 34 cents on the dollar, below the historic average, primarily because lots of defaults in the US were in oil, gas, and mining companies. You probably have read about the problem of oil being very low in value, and the companies that drill for oil or service oil companies have had big financial problems, primarily in the US, which has a huge industry of oil production and exploration. And they financed their growth for many years using debt. And now they've got lots of problems. So the energy mining recovery rate was only 25 cents on the dollar, and all other was 46, about the average. But 2016, this year, look what happened. Now the default rate is above the historic average through September 23rd, already 3.6% and going higher. One of them is Hanjin, because they are filed in the US. The overall recovery rate has dropped to 26 cents on the dollar, lower than the historic average by far. Both oil and gas and all other securities. And so we can look at this analysis using regression analysis. Now, I don't know how many of you have had courses or some experience using statistical techniques like regression, discriminant, and the like. It's a very simple idea. You correlate two or more variables and look at how they are correlated with each other by a regression analysis. And in this analysis, you have default rate on the x-axis and recovery rate on the y-axis. So look at the upper left-hand corner. Those are years when the default rate was low and the recovery rate was high. All there in the upper left-hand corner. And in the lower right-hand corner, we see observations, years, when the default rate is very high, but the recovery rate is low. In other words, there's a significant negative correlation between default and recovery rates. So if you're a banker or you're an investor in debt securities, this is very important, because it means that when you have a distress period, you're going to suffer twice: high defaults and low recoveries. And so you better understand that when you are estimating how much yield you need to compensate you for the risk. It's called loss given default, LGD. And bankers need to do stress tests. So in Korea, when you had huge defaults back in 1997, 1998, you not only had many companies going bankrupt, but you had very low prices of the bonds after they went bankrupt. Most of you are too young to remember 1997, 98. But let me tell you what happened, just so you'll know. Korea was one of the Asian tigers with big teeth, and was growing at more than 10% a year for about 10 years. In December 1996, the end of 1996, Korea had a bond rating of AA-, one of the highest in the world. It was considered one of the high growth areas, certainly in Asia, if not the rest of the world. And you had about 30 chaebols, giant conglomerates like Samsung, LG, Kia, Hyundai, etc. And they were big, powerful companies. 6 months later, the bond rating dropped from AA to BB. The bond rating was way up, AA-, fourth from the top. And within 6 months, it dropped to BB-. And 6 months later, if it wasn't for a bailout from the IMF of $50 billion, Korea would have defaulted on their debt. How could a country go from AA to default so quickly? Very simple. Enormous amounts of debt that was used to fuel the growth of your economy for 10 years or more. And who was providing that debt back then? The banks. And why did they do it? Because the government told them to do it. In other words, they said, we must continue to grow, and the best way to do it is to provide low-cost debt capital to the companies who could then make investments. But they forgot about one thing called defaults. And the ability for the central government to bail out the banks who were making all those loans. And the Korean government in 1997 had about 50 billion US in reserves. You could bail out about 2 big Korean banks with $50 billion. And so the central government, and particularly the central bank, told the banks, we can no longer bail out all the banks if you get into trouble. And the banks had to tell the companies, no longer could we continue to supply so much debt to you at low interest rates. And do you know how many Cherbals went bankrupt within 1 year? 7. 7 out of 30 went bankrupt. And the entire country had to be bailed out. And of course, you have successfully restructured since. But that's a very important lesson for the world to know going forward. And we see this happening now in other countries like China that are growing enormously, mainly through debt financing from banks and non-bank shadow banking. And I'm very concerned about not only China, but the US growing or trying to grow mainly by using debt financing and enormous increases in leverage. And we're going to pursue that. Let's go to the second metric, recovery rates. And as I said before, the recovery rates have now dropped below the historic average. Strike 2. High default rates, low recoveries. But interest rates are really low. And investors are saying, I want yield. Where can I find the yield? High yield bonds. And they're pumping a lot of money because the central banks are providing liquidity. Enormous amounts of liquidity. And so let's go to the third metric. Let's look at this graph. A very important graph here, so let me explain it. This graph, very important. This is what's called the yield to maturity or option-adjusted spread between risky debt and what we used to call the risk-free government rate. We don't call it the risk-free rate anymore. We call it the benchmark rate. Because we know now that countries can default. In 1997, what country do you think in all of Asia had the most vulnerable private sector to financial distress? Let me repeat the question. What country in all of Asia had a private sector, mainly corporates, industrials, non-industrials? Which country had the most vulnerability to financial distress in 1996, 97? By the way, do you remember where the crisis started? Thailand. And then it spread to Indonesia. And then it spread to Malaysia. And then it spread to East Asia, Japan, Taiwan, Korea. What country was numero uno, the highest risk? Thailand, second most risky. Indonesia, third most risky. Who was numero uno? You were. South Korea. How do I know? Well, the World Bank did a study in 1998. You can check out their website. And they calculated the average Z-score for publicly listed companies in every Asian country and South Korea. was numero uno, number one, having the most risk. And that's exactly what happened within 2 years. And it wasn't because you were a third world country. It was because of how you financed your growth for 10 years before that. And of course, we learned the hard way about this. And that is going to be a lesson that I hope you can learn about how we assess country risk, which we will come back to this afternoon. Okay, the yield to maturity spread. It's like a risk premium. How much above the risk-free rate is the market requiring given the riskiness of that market? And in the left-hand side of the graph, June 12th, 2007. The spread between high-yield bonds and treasuries was 2.6%, or 260 basis points. Ladies and gentlemen, that was the lowest spread ever in the history of mankind. We like to dramatize our lecture, History of Mankind. 2.6%. Historic average, 5.25. So we were about 2 standard deviations below the average in 2007. Incidentally, 2007 is going to be a very important year to consider in our discussion for the next half hour. It was the year before the great financial crisis. It was the year when we were in a wonderful benign credit cycle. Low defaults, high liquidity, high recoveries, and low interest rates, and low spreads. Anything could get financed in 2007, particularly in the US. It all changed very dramatically in 2008 and 2009. And as you can see, that spread began to go up as there were indications in our economy of financial distress. Particularly, do you remember where the problems were? Subprime mortgage-backed securities, derivatives on mortgages. But I was worried about the corporate market. And I remember I was giving a speech to a very large French bank in Montreal, Canada, in winter of 2007, when interest rates were low, liquidity was high, defaults were low. It was a wonderful period. And I was sounding a red light, or showing a red light about potential problems. And at the end of the lecture, the president asked me to speak to him. And he said, you know, Professor Altman, that was a very convincing discussion. If I follow what you're saying, as a bank president, I should be reducing my risk, hedging, maybe even going short credit through the CDS credit default swap market. I said, well, that's very flattering. Thank you very much. He said, no, I don't have the courage to do that. I said, I don't understand. Why do you need courage if you think it is the right strategy? He said, you don't understand my job. I said, yes, that's probably right. That's why you're a bank president and I'm a college professor. He said, no, I'm serious. You don't understand my job. I said, well, what do you mean? He said, if I follow what you say and I get off the train or I stop lending and reduce my exposure, But the train keeps speeding down the track, and the party keeps going, and money remains cheap, and defaults remain low. But I get off the train, I'm going to lose my job. If you are right, and we have a crisis, and I reduce the risk, I'm going to get a big bonus. So from a risk-return trade-off, as a bank president, it's much easier to stay on the train, to continue to dance and to party with everyone else. Because if I get off and I'm wrong, I'm finished. And a lot of smart people saw the risks, but didn't do anything about it because they didn't have the courage. So I learned something from that lecture. With respect to the spreads, look what happened. So here we are in 2007. And then you see the spreads start going up as we encountered some problems in mortgage-backed markets. And then you notice in March, April 2008, it was about 800 basis points, the spread, about 300 above the historic average. That's when a very large investment bank called Bear Stearns needed to be bailed out by JP Morgan Chase. And the markets calmed down. They said, okay, too big to fail. Don't worry about Bear Stearns. Don't worry about any bank. No problem. It's going to be okay. But then things got worse. And in September of 2008, right here, we had Lehman Brothers. You may remember that Lehman Brothers was one of the few large investment banks that was permitted to go bankrupt. Others were bailed out. And they were bailed out because we were concerned with systemic risk. If all the banks fail at the same time, then the entire financial system would crumble. But they felt Lehman Brothers was not that important. They were wrong. Lehman Brothers was very important. And look what happened to the spread. In December 2008, the spread went to over 2,000 basis points, more than 20%. No firm could afford to finance their debt when they had to pay more than 20% above the risk-free rate. So if the risk-free rate was, say, 4%, 5%, that means the cost of debt financing for companies was 25, 26%. Nobody can afford that. Typically, companies borrow when their cost of debt is low, like today, very low. And so companies are rushing in today to borrow money. Investors are rushing in to lend money because that's the only place to find yield. So we have a perfect scenario today for increasing leverage in the system, particularly in the US and in China. The two biggest countries of the world now are growing mainly through debt financing, not equity. Very little equity financing going on. And so the debt-equity ratios of companies in China and the US are becoming very inflated. Then, after 2010, notice that the spread has gone above and below the historic average, but has been relatively low. Then we were in January and February of this year, when it was 800 basis points, 800 basis points in the beginning of this year. Again, 800 basis points begins to show that the market is concerned with future defaults and problems. But, like I said earlier, the 4 biggest central banks of the world said, this is a signal of problems. Let's do something about it by providing very low-cost debt financing to banks and also to lenders in general. And so it worked for a while. And we are now back in a benign cycle with respect to spreads, when you can see that the spread today, 519 basis points, just about the historic average, which means that the market is not too concerned about future defaults. This is one of the symptoms of a problem. When the market gets very complacent, it will take on more risk. They forget that the more debt that is used, particularly at very low ratings, it means probably a lot of defaults later on. So let's see what could happen. This is the actual yield. So the yield to maturity today on a high yield bond, 6.78%. That's a pretty good yield when interest rates on long-term debt for governments about 1.2 or 1.5%. And by the way, not only can you buy bonds, but we have now ETFs. You have ETFs here in Korea? High-yield ETFs. So you don't have to buy a bond. You buy an ETF that invests in baskets of high-yield bonds. And money is flowing into these ETFs. Because investors, they say, okay, I don't understand bond investing, but I do understand ETFs. So I can buy an ETF on junk bonds. And money is flowing into that system. Now, I will skip over the forecast and talk about a model I built in 1989 called mortality rates. Let me explain what I mean. In the insurance industry, many of you, and certainly probably your parents, have life insurance. So you probably have a pretty big life insurance industry here in Korea. I know they have it in Japan. They have it in most countries of the world. And how is it determined how much premium you have to pay to take out life insurance? Well, it's called actuarial science. And an actuary looks at the expected life of people and then chooses a premium level to compensate the insurance company for the risk of mortality. So for example, what is the average life expectancy of a newborn baby boy in Seoul today? How many years? Anybody know? About 80? Okay. It's about 78 in the US. And a newborn baby girl? 103. No, I'm only kidding. But in the US, maybe also in Korea, women live long, girls live longer than baby boys. Except in the finance industry. Lots of stress. No, I'm only kidding. I'm only kidding. But if the baby lives for 1 year, the life expectancy changes, and 2 years, and 5 years, and 50 years, and 60 years. So a boy who lives to age 60 has a life expectancy today of about 85. It's called contingent probability. Contingent on survival up to a point, you have a different life expectancy. And that's why the premiums change as the baby gets older. Incidentally, what country of the world has the longest life expectancy of any country of the world? Anybody know? Monaco, Monte Carlo. 89 is the life expectancy. They have lots of money, you know, so they have lots of money to spend on doctors. By the way, Hong Kong, very high. I was surprised. You could hardly breathe there, but people live long. Mainly because very good babies, taking care of a first year, second year of the baby's life. Okay, we have a concept called marginal and cumulative mortality rates. That says, given a certain characteristic at birth, what is the likely mortality or default 1 year, 2 year, 3 years after? And we have marginal and cumulative mortality rates. I won't bore you, but let me show you the results. And we update this data every year. And instead of boy or girl bonds, we have AAA, AA, A, triple B, double B, B, triple C. From the most beautiful bonds to the most ugly bonds, triple Cs. Do you know that the cumulative mortality rate of a triple C for 5 years is almost 50%? And even single Bs. How much is single B for 5 years? What's the cumulative rate? About how much? 5 years for single B. 28.17. In other words, and by the way, single Bs is the dominant junk bond. There are more Bs than anything else. And you can expect, this is based on 40 years of financial history, that 28% will default by the 5th year. But 72% will not default. And you are compensated with high yield for that risk. And it turns out, from a risk-return trade-off, Bs are a pretty good investment, even though we have 28% default rate and about 20% loss rate. So you can expect to lose 20% of your money by the 5th year. But you make about 5.5 or 6% a year compounded for 5 years. So I can do a risk-return analysis for any bond given a certain rating at birth. And we built this model called mortality rate for bonds, just like insurance actuaries build it for people. Why is this important? Well, by the way, this is the mortality loss table. So 5 years, single Bs, the expected loss is around 20%. Yes, you lose 20% of your money from defaults, but you are earning a spread over treasuries of about 6% a year. If you compound 6% for 5 years, it's a pretty good return, net of defaults. And this is the way we analyze high-yield investments in the US, by comparing expected return with probability of loss. And this is why this industry is growing so much. People or professionals are doing this analysis. So let me skip over this and ask you now an interesting question. And I know you don't think about this, but humor me and try to answer this question. Is the average American company today more or less risky than it was in 2007? More or less risky? What I mean is the probability of default higher today than it was in 2007? Remember, 2007 was just before the financial crisis. Okay. How many of you think that today's corporate risk profile is less risky today than it was in 2007? Less risky. Raise your hand. Less risky. Okay? Good. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. How many think more risky today? Oh, good. Even better. More than 10. And how many think about the same risk? Equal 07 and today? Nobody. And then finally, how many don't think? Yeah, okay. This is a standard professor question. Well, I didn't know the answer. So I decided to use a metric, a model that I built called Z-score. When we discuss Z-scores in more depth after the coffee break or tea break, you're going to see that the model looks something like this. This is the original Z-score model that we built in 1968 and published. 5 financial variables, 5 sets of coefficients. The coefficients were determined by a computer algorithm where the objective was to predict bankruptcy within 2 years. Standard financial accounting measures. You're going to see a similar model that we built for South Korea in 1995. And then we'll look at some recent events using that model, again after the break. So what we decided to do is to compare the average Z-score in 07 with 2014. And my assistant is now working on 2015 data as we speak here. And the result? Well, before we get to the result, I want to show you something. It's called bond rating equivalence for Z-scores. So the score has a meaning because it is associated with a certain average score for bond ratings, from AAA down to CCC. And here's the results of our analysis. We had 2 samples, Z and Z double prime, which is another model that we built mainly for non-manufacturing companies, like retailers, construction, real estate, service firms. The Z model was built mainly for manufacturing, industrial companies. So we had 2 models, and we looked at a sample of firms in 07, 2012, and 2014. And in the second column, the median Z-score, you can see that the average in 2007 was 1.81, and in 2014, 1.80. Basically, the same average then and now. So my conclusion is that companies today are about just as risky as they were in 07. Is that good news or bad news? What do you think? Bad, because it was right before the crisis and right before the default rate went way up. Of course, there is that famous book called This Time It's Different. You've heard that name before? Well, what they're saying is this time the markets are different than they were in 07. Yes, it's true. We don't have a subprime problem. Also, we have much more aggressive central banks than we did in 07. But the fundamentals are not any different. Just as good or bad as they were in 07. which to me is not a good news. Finally, let me skip over this and talk about new issues, CCC level. Now again, in the United States, we have a very liberal market. Even companies with the lowest rating can actually sell bonds. And investors can get very high yields relative to other bonds. But remember about the default probability of CCCs. So what year had the highest CCC issuance? 2007. 37% of all high-yield bonds in 2007 were CCCs. And then, of course, we had huge defaults in 2008 and 9. Then it dropped, 2008, 2009, 10, 11. In 2013, 21%. 1 in 5 bonds were CCCs. 21, 16, 11, 10, 16, 13, and so on. Yes, it's not as bad as 07, but there's been an enormous amount of increase of debt financing at low quality ratings in the last 5 years. If history repeats itself, and we see the CCC cumulative default rates being as high in the future as they have been in the past, many of those bonds will default in the next couple of years, including this year. And of course, we are observing that right now. Let me now conclude with one other type of statistic, and then we will reach a conclusion, I hope. Now, this is something that you may or may not have had any experience in. Do you have in Korea a private equity industry? You have private equity firms, and do you find that they sometimes buy companies by issuing bonds called leveraged buyouts, LBOs? Yes? Okay. It's an enormous industry in the US. Private equity firms issuing bonds to buy out the existing owners at a significant premium over the current stock price. Usually 30 to 40% premium, maybe more. So it's called leveraged buyouts. And how much they pay for the company can be articulated through a metric called purchase price multiple. That's for every $1 of cash flow, how many dollars is being spent to buy the company. It's called purchase price over EBITDA, earnings before interest and taxes plus depreciation and amortization. So those of you who are familiar with accounting measures like EBIT, earnings before interest and taxes, or EBITDA, cash flow measure, 2007, what was the average purchase price multiple? How much? 9.9 times. About 10. For every $1 of cash flow, the average price being paid was about $10. For every 1 won, 10 won was being paid to buy the company. In 2015, 10.9. 2016, first half of the year, 10.5. We are now higher in terms of the amount paid per dollar of cash flow than we were in 2007. And the more you pay to buy a company, the more debt you have to borrow to pay for that premium. And the portfolios of our private equity industry are full of companies, from small and medium-sized to very large companies. You'd be surprised how many companies are owned by private equity firms, even though they still continue to have their name. So this is a problem. And then finally, we have something called debt to EBITDA ratio. For every $1 of cash flow, EBITDA, how many dollars of debt does the firm have? Back in 2007, 6.6. For every $1 of cash flow, the average amount of debt was $6.6. Today, about 5.5. Not as risky as 2007, but pretty high. So we watch these metrics, and we are concerned. We are still in a benign credit cycle. Lots of debt, low interest rates, but default rates are rising. Recoveries are falling. Liquidity is still good. And every time our Federal Reserve System is thinking about raising interest rates, they don't do it. They find some reason to continue to pump money into the system. Usually, it's either having to do with unemployment or jobs, or some problems in the stock market or the bond market. We do expect that in December of this year, the Fed will raise interest rates for the first time in 1 year, and the second time only since 2009. But only a very small amount. And the central bank is committed to continue to try to assist the economy to grow. But it hasn't worked very well. Our growth, if you heard Professor Barrow's speech earlier today, our growth has been very low. Your growth is pretty low today. 2.5%, the Korean economy. That's about the same as ours. Yes, it's positive still, better than Europe, but not very much. And so with low growth, we're going to find the central banks continuing to pump liquidity. And how do you do that? It's by buying debt. Even corporate debt now is going to be bought by the European Central Bank and the US. It has to stop sooner or later. And if it does, we could have another meltdown. Now, I don't think, my conclusion, I don't think we are in as bad a condition as 2007. But the fundamentals are not good. But the money is pouring in. Investors and companies borrowing. And so their debt equity ratios are much higher than historically average. So the baseball game is still in extra innings. But I was telling this analogy to my dentist a few months ago. By the way, I get most of my information from my dentists and from taxi drivers. They're the ones who tell me about the markets. And he said to me, that's a very interesting analogy. Baseball, extra innings. He said, what happens usually in extra innings? Well, you have relief pitches. Usually you have your best relief pitcher in the 9th inning, and maybe your second best in the 10th inning, and the third best in the 11th inning. But when the extra innings go very long, you're usually left with your worst pitches. And then it's more likely that someone will score runs and the game will be over. Is that going to be the same in financial markets? So, if you believe that the fundamentals are very bad and we could have another stressed cycle, just like the banker who didn't want to get off the train in 2007, we have to have somebody saying, we've got to regulate the amount of debt. And I think, to be honest with you, the Chinese government, the US government is beginning to realize that. But how successful they are is another story, because investors still are looking for yield. And the only game in town is the high yield market. Stocks are not doing well. Dividends are not doing well. And so, more money, easier for companies to borrow.
The World Knowledge Forum